Dear students, today we will be discussing about a topic called as behavioral finance. So, what is a behavioral finance? A behavioral finance is a relatively a new field that seeks to combine behavioral and cognitive psychological theory with the conventional economics and finance to provide explanation for why people, right? It is a kind of a finance which will provide you a relatively a new field, right, that seeks to combine both behavioral and the cognitive psychological theory with the conventional economics and finance to provide explanation for why people they want the particular things. So that thing is called as a behavioral finance, right? Those things in detail we call it as behavioral finance. So if you see the meaning of behavioral finance, what behavioral finance is, this study of this field of study argues that people are not nearly as rational as traditional finance theory makes out. For investors who cares about how emotions and biases drives sharp prices, behavioral finance offers some interesting description and explanations. So earlier days in traditions, the people were knowing about only finance and economics. But now, when both the things, the behavior of the person psychologically, when it is compared with the economic aspects together, that term is called as a behavioral finance. Traditionally, the finance was just a theory where a traditional finance theory was different. But in modern concept, we tell it as a combination of behavioral finance is called as combination of finance with that of the other aspect called as economics. So the aspect of behavioral finance, if we see that aspect, there are two different aspects. First is the behavioral finance are the behavior of the investor and the behavior of the market. See, the behavior of the investment depends on two things, two aspects again. First is about his own personal individual finance, and second is the psychological kind of behavior, right? A psychological behavior. When we combine these two things, then a thing, whatever is existed, that is called as the behavior of the investor. So that is a part of a behavioral finance. Like an investor, he has some sort of money. Now he want to invest those particular things for one particular uh, kind of goal. Now money, whatever things are there, those money are the part of economics. And now psychologically he is investing for one of the object of his life. Like he is investing money for getting a good car, a good house. Psychologically, those are the psychological impact. So such behavior of the investor are the part of behavioral finance. Similarly, the behavior of the market as a whole. So what is a market? A market means when all individual separate people, when they are combined at one particular place with one particular objective, that becomes a market. So in the behavioral market, the behavior of the market also depends on the behavior of the investors, right? So if the investors behavior is changing in a different way, the market will change, right? And the investors behavior is not changing, the market doesn't change. So the aspect of behavioral finance depends on two things: behavior of the investor as well as behavior of the market. Now there are certain theories of behavioral finance. The first theory is prospect theory, regret theory, anchoring theory, over and under reaction theory. So what is a prospect theory? Sorry, regret theory. Regret theory is the emotional reaction to having made an error of judgment. Whenever some customer or an investor has made any kind of error while judging anything, so he is going to regret, right? And then if he would have sold that, or if he has bought that, sold that, or any other things, whichever is regretting any customer or any investor, embarrassment is there. or investor is reporting any kind of loss, and due to that he will think that this would have done. So those theory of behavioral finance are called as regret theory. Anchoring theory is that is a it is a phenomena in which, in the absence of better information, investor assume current market price. So investor is going to look at the market, and whatever is the market price, that he is going to believe it, and then the people, the information what investor is getting, according to that he's follow, right? So such kind of behavioral kind of theory is called as anchoring. Like you see the news anchors, so generally whatever anchors are telling, people will believe it, right? News anchors might be the information is correct, not, so they don't do any investigation, right? So here also anchoring in the sense, whatever market is portraying, right, the prices of the shares, that whole thing investor will see it, and by that he is going to follow towards that, those things. So such kind of theory of behavioral finance is called as anchoring. Over and under reaction, in most cases over and under reaction is where psychologically he will first sometimes overrate something which is not actually rated at that particular value. He'll overrate something, and in sometimes he will underrate. The things are much better, by maybe because of lack of some talent, or he is not have got the better outcome, due to that underrated has done. So even that is also a theory where may be called as overrated and underrated reactions. The next topic for the discussion is financial engineering. So what is financial engineering? So a financial engineering involves the design, the development, the implementation of innovation, financial instruments and process, and formulation of creative solution to the problems in finance. There are various problems in finance. To develop a design and to have a development, a design, implementation of innovative financial instruments and process to solve those all kind of financial problems. So that is called as a financial engineering. Okay, so there is a process involved in financial engineering. How the financial engineering is done? First of all, identification of need is important, right? Whenever a financial engineering is done, the most important thing is what are the needs, right? The financial needs, what are the things are required to be done, right? Or what are the changes required to be done? That need has to be found first. Then initial sketch of the product. So what kind of product you want, in what particular category, right? As you are doing a financial engineering for some related problems, so what kind of sketch or what kind of product you want, that is initial sketch of a product has to be done. Complex model building exercise. Now once you done the initial sketch, now we should take some exercises with some cases, and then you have to make that initial sketch whatever was prepared with a particular product, or some complex kind of some difficulties should be taken, exercises should be taken, some cases should be taken. Then we need to try to build with those exercise a complex kind of building, model building has to be. Then testing of the product has to be done. Whatever product we built with that financial engineering, whether that product is working well or not, the testing of the product has to be seen, right? Then perfect product on the basis of exercise. So once the testing is over, we need to make so many other kind of exercises, and we need to solve the exercises by seeing after the testing is over, again few many exercises are there, those exercises has to be solved. Then once you solve the exercises, then pricing of the product. If you prove that in all exercises it is having giving you the good result, and it is favorable result it has, so once all thing is there in your control, the next term you need to do is restructuring of the product, right? Pricing is done. After pricing the product, restructuring, reframing the product. If any essential things are required to be, alteration has to be done, or some changes you require to do, in those all cases the restructuring in the product has to be done. Then again you need to do test marketing. Directly you should not release in the market, so you need to give some samples, descriptions, and some kind of things in the market, and then you should see how it works in the market, right? So testing in the market is very important. Finally, you should launch the product in the market, launching of the product in the market. So this way you can do a financial engineering in the process of financial engineering. So the third topic for the discussion of today is financial derivatives, right? Financial derivatives. So what are financial derivatives? A derivative is a financial instrument whose value is derived from the value of another asset, which is known as underlying. So a derivative is what? It is not having a direct value. It is its value is derived, or its value will come into a picture from the value of another asset, all right, which is known as underlying. When the price of underlying changes, the value of derivative also changes. When the price of one particular underlying will change, the value of your derivative is also trying to change, right? A derivative is not a product. It is a contract that derives its value from change in the price of the underlying. Like for example, the value of the gold future contract is derived from the value of underlying asset, right? So here gold is the value, underlying value. So the future contract you did, it is a kind of derivatives. Okay, now let us see traders in the derivative market. There are three different types of traders in the derivative market. First is hedger, speculator, and the third is arbitrator. So who is a hedger? A hedger is someone who faces risk associated with the price movement of asset and who uses derivative as a means of reducing the risk. He is a person, instead of investing money in some companies or some of some areas. So
मेन पे
what he
आपका
does is, this hedger, what he does is that
खत्म हुआ तो रिजर्व पे डाल
he is hedge it, or he is going to have a particular thing called as hedging.
ये क्या पाव के लोड्स बने
Okay, a hedger is someone who faces the risk associated with the price movement of an asset, right? A different assets are there, he will face this particular problem. Speculator, a trader who enters the future market for pursuit of profit, accepting the risk in India. Right? He is entering in the business for the sake of profit. He is a speculator, right? Speculator. Now, finally, arbitrator is a person who simultaneously enter into a transaction in two or more markets, right? Two or more markets. Now, he will take an advantage of discrepancy between the prices in these markets. He will see that he will enter in two markets, different markets, and he involves making the profit by entering into markets. So such kind of persons are called as arbitrators. Now, what are the economic benefits of derivatives? The economic benefits are like it reduces the risk, right? If you invest in the derivatives, because it is not having a direct price, as it is controlled and having a price of some other asset, it is derived by the price of some other asset. So it reduces the amount of risk. It enhances the liquidity of underlying asset. The liquidity of some different assets or underlying assets will get enhanced. Lower transaction cost, right? The transaction cost here will be very, very low compared to the other kind of cost. And enhance liquidity of underlying assets, right? The point is repeated. Enhance the price discovery process. The price discovery process will also get improved, right? You can easily come to know about the price, right? Then portfolio management can be done, right? With the derivatives, you can manage all your portfolios. Portfolios are the different sectors of your investments. So in different places you have invested your funds, you can manage all your funds properly because of derivatives. So portfolio management can be done a proper way, right? Then provides signals of market movements. There will be a signals given about to the investors about market movement. You will get different signals of market movement. Then facilitates financial market integration. Finally, it will facilitate to the investors for the market integration. They will be having a better market integration in the market. So these are few of the economic benefits of having a merger of having a derivatives